There are warning signs before any real estate crash. In fact, there are signals that always present themselves before every major correction or every crash. And you may not recognize it just yet, but we're at the start of something potentially really big. Something that usually happens before a real estate crash. And I'm going to go into what these items are, what you should be looking at, and why these things typically precede a real estate crash. What's more is I want you to hang out until you understand what the quintillion effect is. When you understand this, you'll start to see it coming time and time again, and then you can position yourself accordingly and potentially take advantage of the next one. Let's start with the real estate signals. We have over-leveraged buyers, stalled pre-sale projects, developers that are pulling back, investors that are nowhere to be found, rising inventory, declining sales volumes, increasing things like insured mortgages up to 1.5 million, and getting rid of GST for first-time homebuyers. These aren't random events. These are signals that something is wrong. And every single real estate crash we've seen began with these kinds of conditions. And in this video, I'm going to walk you through the phases that always show up before a major housing correction. Not in theory, but in real numbers and in historical fact. We'll connect the dots between what's happening now and what's always happened before these events. In May of 2025, Vancouver hit over 17,000 active listings. That's a 10-year high. Condo inventory alone was at 7,300. Meanwhile, sales volumes dropped 30% below 10-year averages. And that's not just a slowdown, that's the demand floor falling out from underneath your feet. And the sales to listing ratio is sitting at 13.4%. That's hovering, albeit in a balanced market territory, but in many ways, it is a buyer's market out there. And that's across all property types too. When you start looking at more expensive property, we are deep into buyer market territory. This is a threshold where prices almost always begin to drop. And prices don't crash when people stop buying, by the way. Prices crash when everybody tries to sell at the same time. We're not entirely there yet, but it's likely it's begun. So let's zoom out a minute here, because if we're headed into a crash, it won't just be from housing signals. There will be signals across the broader economy. So let's have a look at what some of those things are. Inflation. So in May, Canada's CPI held steady at 1.7% year over year, but core inflation was near 3%. June's CPI is also expected to rise from 1.7 to 1.9%, with shelter and food driving this for the most part. Why this matters is because if the core inflation numbers are above the target band, then it's going to force the central bank to act. And if they're above, you'll see interest rates go up, making things more expensive and further slowing down the economy. It forces the Bank of Canada to keep rates high, which really doesn't help address the problems that people face right now. If we look at interest rates, the Bank of Canada held its policy rate at 2.75% in June, and with prime rates nearing 4.95%, it's double what we've seen in 2020 and 2021. And mortgage renewals are crushing households. Even if homeowners can renew and the mortgage rate is much higher than where it was, it doesn't leave any money for anything else, and that'll show up in the economy later on. Even though markets are expecting rate cuts later this year, the delay in doing so is squeezing the cash flow and suppressing credit, and this further exacerbates the problem. Moving over to employment, well, June added 83,100 jobs, dropping unemployment to 6.9%, but most of those jobs were part-time. And the PMI's employment index dropped to below 50, and that signals a contraction. Yes, we added jobs, but most of them were part-time. They're not sustainable, long-term economy growing jobs. Certainly not jobs that pay for a $900,000 mortgage. And that brings me to consumer confidence. The index remains stuck below 50 at 48.8%, showing persistent pessimism. Canadians just aren't optimistic about the economy. And that's showing up in spending and buyer behavior, especially when you start to consider the wages versus the debt scenario. Wages only rose 3.2% year over year, but debt loads remain exorbitantly high. Canadian households are among the most indebted of the G7 nations. In fact, I think they're one of the most indebted in the world, period, with mortgage debt nearing $2.2 trillion. So this makes any kind of rate adjustment up or down a huge deal because there's just simply no room left in these rate cuts or rate hikes for people to absorb. There's very little cushion. Let's have a look at some of the leading indicators now. So models like the Canadian Recession Probability Index show an 84% chance over the next 2 quarters of us slipping into a recession. These aren't just academic metrics. They've correctly predicted the last few downturns, and right now, they're sounding the alarm. If you zoom out for a second and you take off your Keynesian economics glasses and you put on your Austrian economics glasses, it's actually fairly easy to see what's going on. Real estate bubbles don't just emerge randomly. They're the result of artificial credit expansion, cheap money, and malinvestment. For decades, central banks have manipulated interest rates. We're well aware of this, allowing credit to be created out of thin air. It's basically lending money that didn't exist in the first place. And this then creates the illusion of endless demand, endless expanding economy, and the erosion of your purchasing power. What's the most famous example of this? Well, I think it would be the Paul Volcker era in the US of the early 1980s. After years of unchecked inflation caused by, quite frankly, reckless monetary policy and crony capitalism, Paul Volcker stepped in and raised interest rates to above 19%. The result? The housing market froze. Prices actually corrected hard. It was a bit of a shock to the system, but it broke the back of inflation. This is really, really important to understand because it then leads to the next phase, which is quantitative easing. And quite honestly, the fragility of the fiat system. Quantitative easing, or money printing, is effectively what it is. There's a fancy name for money printing. It floods markets with liquidity. It did so in 2009 to bring us back out of the 2008 burst, and then in 2020 and beyond. In fact, many people in 2008 now feel that that was a great reset, which is something to consider when you look at what's happened since. But all that free money went into something. It went into asset inflation, especially housing. Without hard money constraints, as in you can't print more money, then central banks have no limits and can continue to produce money out of thin air to carry this on. It just isn't sustainable because eventually nobody can afford to buy anything. It creates these boom-bust cycles that take place every 8 to 12 years. And unfortunately, we find ourselves at the peak of one of them right now. In fact, since COVID, if you look at what's called the hurdle rate, which would be the rate of inflation plus the rate of new money expansion, the rate of new money expansion has been about 8 to 9% in the post-COVID era. And average inflation rates are at about 3%. So when you add the two up, 3 plus 8, you end up at 11%, which means that's likely the real rate of inflation because that's the rate of your purchasing power that goes down every single year. In fact, if you look at that over a 10-year period, it means that your purchasing power could drop by as much as 80% in a decade. It's crazy. Hopefully, it slows down a bit. But there's more to look at. Focusing back in now, looking at the debt to GDP ratios, Canada's debt to GDP is hovering around 110%, approaching levels not seen since World War II. The only difference is there's no war. We have a massive spending problem. The government is just printing and spending and printing and spending, calling it investment. I don't know. Because the rest of us are getting poor. The quality of life is going down, the debt to GDP ratio is going up, and our productivity has dropped. This level of leverage is just simply unsustainable, and every interest rate hike pushes us closer to a fiscal wall. And this now brings me to the Cantillon effect. And I want you to pay close attention to this because I think it really explains why this will continue to happen and why even when you save up, you've saved $100,000 for a down payment on a house, and just when you think you can afford that home, the price of that home has gone up now, or the value of your money really has gone down. Here's what I mean. According to 18th century economist Richard Cantillon, the beneficiaries from the expansion of the money supply are the first recipients of that new money. They are able to spend it before it has caused any prices to rise, so they benefit the most. Whoever receives it from them is then able to spend it facing small price increases, and as the money is spent more and more, the price level rises until the later recipients, they now suffer from a reduction in their purchasing power. Does this at all sound familiar to you? This is the best explanation for why inflation hurts the poorest and benefits the richest. In fact, those who benefit are the ones closest to the government, the ones that have government credit, banks, large corporations, asset holders. Those who suffer the most are those on fixed income, minimum wage, those who don't benefit or don't have the opportunity to use that money in the same fashion or at the same pace or at the intervals that other people get. This distortion doesn't just increase inequality, it directly contributes to the housing crisis that we find ourselves in today. The wealth divide is getting worse, and it's getting harder for younger generations. I think older generations need to pay closer attention to this, because if they intend to retire, they have to sell their assets to people, and those people need to be able to afford them for this all to work out. So let's recap. We've got inventory that's up. We've got sales that are down. We've got prices that are starting to slide. We've got inflation that appears to be sticky. Rates are high. Employment is soft. Wages definitely are not keeping up. Consumer confidence is low. Debt appears to be overwhelming and increasing. And recession indicators are flashing everywhere. Credit is largely artificial at this point. QE and fiat money fuels these bubbles, or at least these cycles, to unsustainable levels. I'd love to see the government just take their hands off these controls once in a while, let good ideas prosper and let bad ideas fail. It would be painful at the start, but at the end of the day, we'd be in a much healthier place. That way, entrepreneurs and private industry can go into the economy where it is actually hurting, where those opportunities do exist for solutions to be made by private industry. It's why it's there. It's how entrepreneurialism has always been. But if we continue to print money and we send it into areas of the economy that should otherwise die, then we have ideas that lag on forever that are not productive. We have companies that are not productive, but because they employ thousands and thousands of people, we'd rather them carry on doing jobs that are not productive in the economy than actually repurpose the economy into something more productive. It's painful. But this is the difference between a short time horizon and a long time horizon. Unfortunately, our politicians are only interested in instant gratification and not solving these much bigger problems, because they would largely be very unpopular and it would be quite painful. But nonetheless, it would put us on a much better path longer term. Without a doubt, the Cantillon effect is distorting the society that we live in. Those that benefit are those that are closest to the money creation, and those that don't are the ones that get it last when prices have all gone up. It's not a healthy market. It feels a bit like a powder keg. So what happens next? Well, if history's any guide, we're headed into one of three scenarios. The slow bleed, where prices will flatline or fall slowly. Sellers will capitulate one by one, and overall consumer sentiment drops to the basement. 2, we might see a sudden drop. A shock event hits, like a supply crunch or a credit squeeze or huge job losses or even a liquidity crisis. Prices tend to fall hard and fast. I don't know if we're there yet, and the government still has some levers that they can pull to slow that down. 3, we've got the soft landing, and this is what we've been told time and time again, where rates will come down, inflation will cool eventually, and the market will rebalance. I'm not convinced this is going to take place. Whatever path we take, though, right now, you have to act. If you wait for the market to move and you react, chances are you'll have lost your position because you're now responding to those signals a little bit too late. So if you're a buyer, here's what I'd do. I'd focus on the fundamentals, block out the noise, look at the signals, understand the data. Do not act on any kind of FOMO. Be prepared to walk away from any deal that doesn't work for you right now. Only buy investments that cash flow, and those are very hard to find, which means those sellers are likely facing price corrections until they do. Negotiate hard. Right now, everything's on the table, so why wouldn't you? Think in longer terms too. Get those prices down if you can. Get the better deal if you can get there. Some sellers will be prepared to let it go, but others with much more equity in their property may decide to wait. And that brings me to my next point. So if you're a seller, you got to price ahead of where the curve is trending. Do not chase this market down. You will sell at the bottom. It's like catching a falling knife. If you price yourself behind where the market is on the pricing curve, it gets very difficult for you to catch up, and you will continue to cut your price only to sell at the bottom. Get in front of the curve, sell quickly, and move on to your opportunity. Offer incentives if you have to. Cover some closing costs, throw in some furniture. Look at even a rate buy down if you are building a project or if you're working with banks. If you want to find out more about how to do that, reach out. I can show you exactly how we do that for some of the projects that we work on. And ultimately, if you can't get the number you need or it puts you underwater, then you're going to have to rent it out. But I would move quickly on that rental because more and more sellers are going to come to this conclusion, the conclusion that they need to rent it out because they can't get the number that they want. The only problem is we're going to see a record number of purpose-built rental condos hit the market this year. That will flood the rental market and push rental rates lower. So act quickly. Don't wait. And finally, if you're watching from the sidelines, I would test the waters, but I wouldn't get committed to much at this point. Build your cash if you can. If you've got a good job, try and contribute to your savings. Stay liquid. Have some dry powder because opportunities will begin to present themselves like they otherwise haven't before. Stay informed. Listen to videos like this to find out what's going on. And be ready to move when other people begin to panic. That's your opportunity. And lastly, I would recommend, whether you're a buyer or a seller, to be working with somebody who's been through cycles like this. Whether it was the 2016 foreign buyer tax crunch that we saw, whether it was the COVID blast that we went through in terms of prices, only to be followed by a complete roller coaster ride back down the other way. Whatever you're doing, make sure you're working with somebody who understands these cycles, who knows where the signals are. As long as you look at the signals, you'll be fine. Don't listen to the noise because you'll make a mistake.